Hi, everyone. Paul Lightfoot, and I want to thank you for joining us today. Today, we're going to walk through some of the key tax, retirement, and estate planning ideas that can make a meaningful difference as we head toward year end. Our goal is simply to help you understand what's out there, what may be changing, and what opportunities you might want to keep on your radar. We know everyone is busy, so we'll keep the discussion focused on the most relevant items. With that in mind, we expect the webinar to run for about 20 minutes. Before we dive in, just a quick disclaimer so we're all on the same page. This webinar is for educational purposes only. We're going to cover general strategies, but we're not giving any personalized tax, legal, or investment advice today. If something we talk about sparks a question, just be sure to connect with your tax professional or estate planning attorney to figure out what makes sense for you. And one more note, this information is meant for everyone, not just our clients. Our aim is to provide clarity and help everyone become better informed. With that said, let's jump in. As we get started, here's a quick look at what we'll be covering today. We're going to touch on the core areas that matter most for year-end planning, including tax strategies, estate and beneficiary readiness, ways to reduce and improve tax efficiency, and charitable giving opportunities. Then we'll wrap up with time for questions. Feel free to send in your questions at any time during the presentation, and we'll address as many as we can at the end. Just click on the Q&A button at the bottom of the screen. Let's start with tax planning. Year end is really your last chance to make contributions, capture tax advantage savings, and take steps that can lower your taxable income for the year. It's also one of the best times to make sure you're on track for your long-term retirement readiness. The moves you make before December 31st can have a meaningful impact both today and in the years ahead. First item to consider is maximizing your retirement contributions. Each account listed offers a different type of tax benefit. Together, they reduce current taxable income and increase long-term tax-free or tax-deferred growth. You can see the maximum contributions for each type of account on the slide. Starting with 401ks, I would encourage participants to review 1, whether their contributions are on pace to reach their targets, 2, whether they are fully capturing the employer match, and 3, a review of their contribution options, Roth versus traditional, to determine which may be most advantageous for their situation. For IRAs, technically the deadline for this is April 15th, but contributing to your IRA before year end helps to finalize your tax picture early, making it easier to coordinate strategies like Roth conversions and charitable giving. Keep in mind that the modified adjusted gross income can affect deductibility of traditional IRAs and affect eligibility of Roth IRAs. If your income is too high for a Roth IRA, a backdoor Roth may still be available. A health savings account, or HSA, is a tax advantage savings account for qualified medical expenses available to individuals enrolled in an HSA eligible health plan. It offers 3 benefits. Contributions are tax deductible, growth is tax free, and withdrawals are tax free when used for qualified medical expenses. As a retirement tool, HSAs balances roll over every year and can be invested for long-term growth. And after age 65, withdrawals for non-medical expenses are allowed without penalty. It'll just be taxed like a traditional IRA. It is also important to review any 2025 required minimum distributions. RMDs are mandatory withdrawals from traditional IRAs once you reach age 73. The IRS requires these withdrawals to ensure that taxes are eventually paid on money that has grown tax deferred in your retirement accounts. Missing an RMD can create significant penalties. For RMDs, there's different rules for what they call inherited IRAs, and these depend on the relationship and the date of death. It may be worth considering a qualified charitable distribution to offset the impact of RMDs. We'll discuss qualified charitable distributions later in the presentation. Another tool you can use for tax planning is annual gifts. The IRS allows you to give up to $19,000 to as many individuals as you want within a year without having to file a gift tax return or use up any of your lifetime gift tax exemption. For married couples, they can combine these exclusions together to give $38,000 per recipient per year. Gifts can be used for a variety of purposes, such as assisting adult children or grandchildren, funding 529 plans, paying tuition directly to an educational institution, or covering someone's medical expenses when paid directly to providers. Finally, annual gifting is a simple, high impact way to reduce future estate taxes over time. The last item to be discussed in this tax planning section is Roth conversions. A Roth conversion is the process of moving money from a traditional IRA to a Roth IRA. You will pay income tax on the amount converted today, but all future growth and withdrawals can be tax-free. The benefits of a Roth conversion include: one, they reduce your future RMDs; two, it creates tax-free income in retirement; and three, it's a hedge against potential higher future tax rates. It can also be a powerful strategy in lower income years or years with large deductions. Although this webinar is primarily focused on taxes, year end is also an ideal time to confirm that your estate plan is up to date and communicated to the appropriate people. The first recommendation is to review your beneficiary designations, as these determine who receives your assets immediately at death and outside of probate for certain accounts. They override your will and can create tax and legal problems if outdated, and are essential to ensure your family and your wishes are protected. This applies to life insurance policies, retirement accounts such as IRAs and 401ks, and transfer on death accounts. We also suggest having open conversations between parents and their heirs about their financial wishes. Most families don't enjoy these conversations, but this is one of the most meaningful steps a family can take. And we've seen this in many situations. It is important to talk about the why behind your plan, your values, your priorities, and your legacy, because it often prevents misunderstandings later. We would encourage family discussions around wishes and goals, financial responsibilities, location of key documents, who is designated to act during emergencies, and health and long-term care preferences. Our final recommendation is to revisit your estate planning documents if it's been a while. In general, we would encourage clients to review their estate plans every 3 to 5 years and anytime a major life event occurs, such as marriage, the birth of a child, the death of a spouse or family member, a move to a new state, or a significant change in assets. Keep in mind that estate plans only work if one, they're up to date, two, people know they exist, and three, the right legal documents are in place. We would suggest to review your documents to confirm that they still reflect your current wishes, especially the individuals you named as successor trustees, executors, and agents for financial and medical decisions. The next slide is going to talk about risk and tax mitigation. The year end is a good time to ensure your portfolio is meeting your goals as tax efficiently as possible. Tax loss harvesting is an investment strategy where you sell securities at a loss to offset capital gains from other investments, which can help reduce your tax liability. This process essentially defers taxes, allowing more of your money to remain invested and potentially grow over time. Another strategy is utilizing strategic asset location. This is a tax-efficient approach that places different types of investments in the most advantageous accounts to help maximize after-tax returns. By matching less tax-efficient assets, such as bonds, to tax-deferred accounts, and placing more tax-efficient assets, like stocks, in taxable accounts, you can improve after-tax performance without changing your overall risk profile. With that in mind, the value of the strategy does depend on the mix of account types in your portfolio. The last item on the slide is rebalancing. Rebalancing is the process of adjusting your investment portfolio back to its target asset allocation by selling assets that have grown too large and buying those that have become too small. Over time, This discipline helps keep your portfolio aligned with your goals and risk tolerance, supporting more consistent long term outcomes. While this strategy is centered on risk mitigation, it can influence after tax results, so rebalancing should be executed in the most tax efficient way possible. Charitable giving. Charitable giving isn't about supporting just about supporting the causes you care about. It can also be an effective tax planning strategy. And here are a few ways to make giving more intentional and tax efficient. A new rule to note for the 2026 tax year: itemizers will only be able to deduct charitable contributions above 0.5% of their adjusted gross income, or AGI, which may reduce the value of smaller annual gifts. In other words, the first 0.5% of giving will not be deductible. Only amounts above that threshold will count. Given this change, strategies such as donor advised funds and bunching may be advantageous for annual givers, especially in 2025 before the rule takes into effect next year. I just mentioned donor advised funds. Donor advised funds is a charitable giving account that lets you make a lump sum contribution, receive an immediate tax deduction, and then you can distribute gifts to charities over time. So it gives you flexibility. You don't have to decide day one of who you're going to give it to and where. It allows you to take the deduction and then give out the charity or give out the amounts over time. This allows you to front load charitable giving for multiple years. It is useful for high income years, years with large bonuses, or when selling a business. The next item is non-cash assets, which do provide a larger deduction versus cash gifts. Since you can donate highly appreciated securities to avoid capital gains, this is a great option for long-term stock positions. If you've held it for a long term, you have high capital gains, this is a great opportunity to transfer those out of your estate. A qualified charitable distribution is a direct transfer of funds from your IRA to a qualified charity, available once you reach 70 and a half. The amount given, up to $100,000 per year, can count toward your RMD and is excluded from your taxable income. This is an excellent option for high income retirees who don't need the RMD income. The last strategy is a bunching strategy. It's a tax strategy where you can combine or bunch multiple years worth of charitable donations into a single tax year so you can exceed the standard deduction and itemize that year. It helps you to offset income spikes, Roth conversions, or large capital gains. It works even better when paired with a donor advised fund. You get the deduction up front, but can distribute gifts to charities over time. Moves to consider before the end of the year. Here's a few strategies worth considering. First, maxing out retirement contributions. This takes advantage of all available tax benefits. Remember, 401k and HSA contributions must be made by year end, while IRA contributions can be made up to the April filing deadline. The second one is review your RMDs to ensure all required distributions are taken across every appropriate account. If eligible, a qualified charitable distribution can be a smart tax way to satisfy some or all of the RMD. Another option is to update your estate plan and beneficiary if needed. Take time to review power of attorney, trust, medical directives, and the individuals you named in key roles to ensure that they still reflect your family's situation and long-term intentions. Another option is to determine if the Roth conversion is appropriate. A Roth conversion allows long-term tax benefits and an RMD reduction, but it must be evaluated against the upfront tax cost to determine if it's worthwhile. The last one on the slide is complete charitable giving before year end to capture available deductions. Review the various gifting strategies to find the best fit for your goals. The right approach can reduce taxable income, support causes you value, and create a more tax efficient giving plan. As you can see, the year end planning reaches across multiple areas of your financial life, including taxes, charitable giving, retirement accounts, investments, and estate planning. Coordinating these pieces at year end creates opportunities to optimize taxes, strengthen your plan, and prevent surprises down the road. At Optima, we're here to support you as you navigate these decisions and help ensure everything continues to work smoothly. This is the time to bring up questions. Is there one of the questions that came up? Is there a rule of thumb for consideration of Roth conversions? That's really kind of dictated to each individual situation. So I don't say there's a rule of thumb consideration. It's a more of let's review the entire situation and see if it's right or not right for an individual. And I'd be happy to talk to this individual if they want to continue the discussion. Another question is, can I get a copy of this presentation? And yes, we're going to send a follow-up email probably next week with a recording of the webinar and a PDF of the presentation. Another question is, can I send a copy of this webinar to my children? Yes, the webinar recording will be available online on our website, and you will get a copy of it next week. So if you want to send it to your heirs, please feel free to do that. Another question, is there any additional information I can give my tax professional as we near year end? Historically, Optima sends out spreadsheets that shows the year-to-date actual capital gains and the estimated capital gains for December. These taxable distributions may be of value to your tax professional. I know we're waiting on one last fund company to release their estimated capital gains for December, but we should have all that resolved next week. Another question is, where do you go to open a health savings account? While HSAs are often offered as a work benefit, you may be able to open an account if your employer doesn't offer one or if you're self-employed. Most custodians, banks, and credit unions offer HSAs. I do not see any other questions. And once again, if you have questions, you can email them to Archie, myself, or Angela, and we'd be happy to respond to you about that. Last slide. Thanks again for spending your time with us today. We hope this gives you a clearer picture of the key tax, retirement, and estate planning opportunities to consider as we head into year end. As a reminder, today's discussion was for educational purposes only. So if you have any questions about your specific tax or legal situation, please be sure to touch base with your tax professional or estate planning attorney. Thanks again for joining us, and we hope you have a great rest of your day.